take a look at the bigger picture. Joining me right now, Ed Siddell's with us, CEO, Chief Investment Advisor, EGSI Financial. Ed Siddell, nice to see you. Let's just start out with what we've been seeing in these commodities. I'll talk about OPEC and the production cut in particular, with oil above $80 the barrel and dollar at the lowest levels since February. What does that mean, and why is that important?
Yeah, it's a big deal. First of all, thanks for having me back. You know, when we look at the production of oil being cut, I mean, we went from being an energy exporter, being completely energy independent, exporting oil to, now we're having to import everything. And that's a big deal because it impacts every facet of our life, not just transportation, but, everyday goods, as well as, even pharmaceuticals. So cutting that production, it's just going to continue to raise costs, which is inflationary all the way across the board. So that's a big deal. As the value continues to devalue, I was just looking at it right before I came on. It was about 101 spot, 62. It's not as low as it was the 1st of February, but it continues to go down. And, as we continue to see inflationary pressures, depending on what the Feds do, I would not be surprised if we see it break 100 and be in the 90s before the end of the year.
Right, understood. In the meantime, there are concerns about inflation. The question is what the Fed may or may not do in its next meeting after the quarter hike that we just saw, the quarter hike, quarter of 1%, 25 basis points. Jamie Dimon actually noted what has happened in the banking crisis and that, in fact, it's not over, and that the repercussions could be around for years to come. What do you make of it all, and what does the Fed do?
You know what? I agree. And this goes back to what we've been talking about, even last time we were talking about the debt bubble. There's so much debt that these banks are holding, from commercial real estate to corporations. They've had to extend themselves out to get any kind of return, on these longer term treasuries, and they just can't make a profit. So this is more system wide than what anyone, even thinks. And so, the impact that this is going to have, as far as the Feds look at, especially with the inflationary pressures, of commodities, specifically oil, they're going to have to make a choice. They continue to say, we're going to hold steadfast to that 2% inflationary rule. But if they do that, they're going to have to continue to raise rates, and it's going to wind up breaking the economy and create a very large financial crisis. Now, the other option is they don't raise rates, and they even may do another round of start to lower rates and may even do another round of quantitative easing, which would create just a huge inflationary issue. So I think it was their poor monetary policy, their inaction over the last couple of years that really put us in this situation. And so no matter what, it's going to be tough.
So at this point now, you actually see some rate cuts ahead at some point. Do you think that's more likely at the end of this year or more in 2024?
Unfortunately, as early as the end of this year. We need growth in the economy to kind of get out of this mess. We need some real GDP growth. And we need some business-friendly credit loosening so small businesses can start to grow and create some more jobs. And I think the only way that we're going to be able to see that is by lowering some of the interest rates to create more capital for these companies. But again, that's a double-edged coin because, that's going to be more inflationary pressures, for the country.
Right, understood. At this point now, with a dollar that's relatively low, what do you think U.S. investors should be doing or putting their money to work, or what?
Yeah, right now it's all about hedging. Before the end of last year, I said, I was being cautiously optimistic. But now it's really about hedging, making sure that you stay liquid enough and generating, a good enough return, laddering out some short-term treasuries, but still participating in the market. I continue to like oil. I like energy, utilities, healthcare, maybe even consumer staples going into all the way through the summer. But you need to stay liquid, get a very modest return so that if things do turn around, you can take advantage of it. But you need to make sure that you understand all the volatility and risk involved with everything that's going on in the market.
Right, understand. All right, Ed Siddell, nice to see you. Thank you, CEO, Chief Investment Advisor, EGSI Financial. Thanks, Ed.